Is America crumbling?
Economists are saying the risk of a recession is rising.
We are taking a very substantial risk of recession.
Are you expecting a recession this year?
I hate to predict things like that.
America is known to be the world's largest economy, the backbone of global financial markets, and is now showing cracks. If America stumbles, then what does it mean for Indian investors like you? Today, we are deep diving into the unfolding crisis and what it means for your money. These 7 companies are the giants of AI, cloud computing and digital services. But 2025 has not been kind to them. These companies have collectively lost $1.5 trillion in market value. These are not just numbers, but real jobs, real businesses and real money at stake. When the giants fall, the tremors are felt everywhere. Tech companies are shedding jobs at an alarming rate.
There's real people involved too, right? These are moms, dads, millennials with student debt, and their lives have been turned upside down just over the last few weeks by all these layoffs.
Block Inc. has laid off nearly 1,000 employees. In January 2025, Amazon announced the closure of 7 warehouses in Quebec, Canada, resulting in the loss of 1,700 jobs. Additionally, around the same time, Amazon laid off nearly 200 employees in its corporate offices, primarily within its Department of Fashion and Fitness. The Conference Board's Consumer Confidence Index fell by 7.2 points to 92.9, marking the 4th consecutive monthly decrease and reaching its lowest since January 2021. The Expectations Index, which assesses consumers' short-term outlook for income, labor market and businesses, dropped 9.6 points to 65.2. the lowest level in 12 years. The US stock market has lost over $4 trillion in value due to ongoing trade tensions and tariff implementations, contributing to the fears of economic downturn. While mortgage rates have declined 6.67%, this decrease may indicate underlying economic weaknesses and possible recession because these lower rates are often a result of economic instability. One of the strongest indicators of a recession, the inverted yield curve. Historically, it has predicted over all US recession. And guess what? It is inverted right now. Now let me explain for those who don't know what yields are. Yields are the interest rates of bonds, and a yield chart is graphical representation of the yields. Now investors analyze trends in interest rates for bonds and also assess market expectations for future economic conditions using this yield chart. There are generally 3 different types of yield curves: a normal curve, a flat curve and an inverted curve. A normal curve generally signals economic growth. This happens when long-term bonds have higher yields than short-term bonds. A flat curve suggests uncertainty. This happens when short-term and long-term bonds have similar yields. An inverted curve often signals recession because at this time, the short-term bonds have higher yields than long-term bonds. Now let me explain why so. Because the Fed raises interest rates, making short-term borrowing expensive, while investors buy long-term bonds for safety and lowering their yields. This leads to tighter credit, lower investments, stock market declines, and slower economic growth, often preceding a recession. The first widely recognized instance of an inverted yield curve predicting a recession was back in 1966, while a full-blown recession did not follow, but an economic slowdown did resume. However, the first time inverted yield curve accurately predicting a recession was in 1969, leading to the 1970 recession. The last major inversion was in 2019, just before the 2020 COVID-induced recession. A deep inversion occurred in 2022 to 2023, signaling economic trouble. Many experts are now fearing a slowdown in 2025 because the inverted yield curve is stubborn for the largest period from 2024 to 2025. Now let us clearly understand the current situation. The current situation shows an inverted yield curve that is known to be the longest in the history, a declining stock market value, and then high corporate debt and layoffs, consumer confidence and expectations index being very low. Now if a recession happens in US, history suggests stock market crashes, rising unemployment and falling corporate profits. The downturn in US tech stocks has influenced FII behavior in India. Despite earlier outflows, recent weeks have seen FIIs returning to India, injecting approximately 19,000 crore rupees by the end of FY 2025. The ripple effects of the US tech sectors are evident in India. Indian IT sectors including TCS, HCL Tech and Infosys have faced decline in stock market following the Accenture's release of quarterly results, which raised concerns about growth prospects. The Nifty 50 index has experienced a 10% decline from its peak in September 2024, influenced by diminished earnings growth and unfavorable macroeconomic conditions. In summary, the challenges faced by the Magnificent Seven have had cascading effects on global investment flows and Indian stock market. But India has an advantage: resilience. While US recession would hurt, it could also lead to lower oil prices, stronger manufacturing sector, and increased domestic consumption. America's financial troubles are a wake-up call for the world. For Indian investors, this could be uncertainty, but also an opportunity. Diversify, stay informed, and remember that in every crisis, there are winners and also losers. The question is, which one will you be? Let us keep watching, let us keep learning.